Today's a special day. And it's not because I'm talking to you. It's special for me. It's not really special for you because, who am I? All right, Michael Elliott. But we should talk some news.
Oh, yeah. Well,
that thing. Yeah.
Yeah. We've been around for 3 years and we've had our first product, HFND, which has been around for a while, for almost 3 years, which is really, I kind of like to say, it's kind of like the SPY for hedge funds. It's just basically matching the index returns. It's done a good job demonstrating that we can track how hedge funds are positioned. But we've been really focused in this year on breaking out those individual strategies and offering them to investors at a higher target return, so they're a lot more cash efficient. And so we started with global macro, which we talked about. But today, as you mentioned, is an exciting day because what we've also done is launched 2 additional strategies.
For those that are starting to come in that happen to be financial advisors, do me a favor. If you are physically in office, which, yes, I know is surprising that that's still a thing, apparently, tell your other fellow FAs, fellow advisors about this conversation. I promise you don't want to miss it. For those that are here for the CE credits, I will email you shortly after this conversation to get your information as far as the info that has to go to the CFP board. I am doing my best. I'm pretty much, I think, caught up on all the prior webinars on that. But if you did not get CE credits yet from something you attended before, shoot me an email, let me know. And with all that said, let's get started for a lot of interesting things we're going to talk about with Bob Elliott. My name, of course, is Michael Elliott, publisher of the Lead Lag Report. This webinar, this conversation is sponsored by Unlimited Funds. So yes, I have been a little biased in saying I'm a big fan of Bob's because he's a client, but I am a big fan of Bob's, independent of that, which is why he's a client, as I try to be selective in the industry. Bob, we're going to go over a lot of things. You are a kind of a macro superstar, and I know a lot of people know who you are. But of course, there might be some people who are not on X that haven't seen some of your content or haven't seen you in the media. So maybe let's do just a quick rundown as far as your background and what do you do?
I've been a systematic investor for a couple of decades, particularly from a macro perspective. Most of my career was spent at Bridgewater Associates, where I was on the investment committee and helped create a substantial portion of the strategies in the flagship Pure Alpha Fund across all the major asset classes. I left Bridgewater, I guess now it's 7 years ago, something like that. Time flies, with this idea of sort of wanting to figure out how to bring hedge fund strategies to all investors rather than only the big institutional investors, and do so in a way that was diversified and liquid and low cost. And that's what we do at Unlimited, which is build diversified, low cost hedge fund strategies and put it in that ETF wrapper so that all investors, whether you got $20 or 20 million, you can get access to those strategies. And so we'll probably talk about that a little bit more later. And so my sort of day job is building and running that business, and my and at the same time also continuing my work on the macro economy in all sorts of different places. If there's social media, I'm probably there under the Bobby Unlimited handle in one form or another.
So we're definitely going to talk about the funds, but let's start very top down. I see you do a lot of content and you focus on this idea. This has been an income-driven expansion, but let's take a 30,000-foot view of where we are in terms of the U.S. economy. What's your take on how things are progressing?
Yeah, I think over the course of the last couple of years, I think those folks who focused on this idea that we have, as you described, an income-driven expansion, have had the benefit of a real non-consensus view. First, initially recognizing the economy is likely to be stronger than most people expected, but now starting to see how that income-driven expansion is weakening, and as a result, now starting to shift their views to become a bit more bearish on the U.S. economy than is consensus. And really, when I describe an income-driven expansion, it really comes down to sort of old-time expansion principles, which is what generally drives household spending is income growth, and often what drives income growth is consumption growth by households, and that isn't a spiral; it's just a self-reinforcing dynamic. And what we've seen and that generally hasn't been the story. Generally, credit has been a big story in the U.S. economy over the last 20 or 30 years before this cycle because borrowing was so important. But what we've seen in the post-COVID economy is very limited borrowing and much more income-driven dynamics. And what we're seeing today is a real slowing of that. If you look at what's happening with wage growth, the weakening of labor markets has now driven wage growth per worker down to about 3% on an annual basis. At the same time, the combination of restrictive immigration policy and just general labor market softness has brought labor force growth or labor job growth down to about zero. And so you at some level, the math is pretty simple, which is if you have 0% job growth and you have 3% wage growth per worker, that's 3% nominal income growth in a 3% nominal in a 3% CPI or 3% inflation environment, gets you 0% real demand. And that's basically what we've seen in the economy since the beginning of the year is 0% real demand. And the US economy will not hold up in a 3%, in a 0% real demand environment. And certainly 0% real demand is very different from what's priced into stocks in particular, but also into the bond market, right?
Let's keep going on this income-driven expansion. When I hear income-driven expansion, I'm thinking, well, sure, if there's bargaining power, then labor is going to want more income. You had a lot of that post-COVID, but now you've got this interesting intersection where AI is starting to interfere, right? So talk me through how you see future income-driven expansions in an age where AI is getting more and more accelerated.
AI is like any other technological innovation from an economic mechanics perspective, very important, which is to the extent that a labor saving technology means that you have less labor. It also means on the flip side that you're paying people less money in terms of their earning income. Right. And that's where I say, one man's income is another man's spending, which is that ultimately in the US economy, there are only two sectors that spend at the endpoint, which is either households or the government. Right. And the government mostly engages in transfers. It mostly doesn't do outright sort of GDP spending. And so really what it comes down to is, okay, what happens to household income? Because household income translates to household spending. They're ultimately on the hook for the spending. And so I think the challenge with particularly those folks who are, let's say, the tech mega bulls, they'll talk about, hey, businesses are going to have radical margin benefits from AI. And the answer is, okay, that's great. Maybe they do, but somebody's got to pay for that benefit. Because if you just take a simple business, sure, any one business can fire half its workforce and replace it with AI. But unless those people get additional income, the aggregate sales in the economy soften, and therefore you have an economic slowdown. And so I think that's the real question is, what is the benefit? How big a deal is the AI thing going to be? Which, we could have a discussion about. But really on the flip side is, if it creates a lot of job losses, who is going to make up for that spending? Because if someone doesn't make up for that spending, there is no actual benefit on the top line. The top line will slow, and that will be detrimental to business.
You said the slowdown in income-driven expansion is not priced in to stocks and not bonds. I think we got to expand on that, because I myself have been on this point for the last 2 years that everyone looks at the stock market being the S&P. Meanwhile, small caps are halfway through a lost decade. Right, Russell 2000 basically has gone nowhere. You can argue that's much more closer to the U.S. economy and consumer. Obviously, there's a tech aspect to that, a style aspect to that as well, that explains the bifurcation. But when you say that a slowdown in income expansion is here, which part of the marketplace is discounting it more?
I think this kind of goes to me as a macro guy and a macro perspective. If I just think about what has driven the equity market, and when I say the equity market, like the market cap weighted equity market over the course of the last couple of years, I think a lot of people will be like, AI, innovation, all sorts of stuff. I look at it and I say, no, none of that stuff, man. What happened was growth expectations were super soft in 23 and 24, and the economy was decent. And as we look at the markets today, essentially growth expectations are quite high, meaning sales growth, earnings growth, all that, they're all very elevated. And the real economy is slow. And that is setting up a dynamic for weaker aggregate equity returns. And we get lost in lots of individual stories, but if you're a macro investor and you look at what drives the single most consistent descriptor of what drives equity returns is how conditions come in relative to expectations over the subsequent 12 months. That's it. That is the most consistent driver of equity returns over time. Doesn't mean the most consistent driver over a day or a week or a month, but it does mean over something like a 12-month time frame, which is what most people care about. That is the most consistent driver. And that's the divergence that we're seeing today.
Let's apply that to the bond market. And in the same way, there's a nuance, right? You've got duration, you've got credit. I think people, when they talk about bonds, they often don't think in those two terms. Treasuries obviously have had a very different performance than junk debt, as an example, over the last several years. Talk me through sort of the way you view bonds here.
Yeah, so I think if you look at the treasuries, when you say bonds, I think treasuries. That's what I'll say as a macro guy. I think treasuries. At a big picture level, like basically what we have is we have yields that are at cyclical highs at a time when the economy is slow, and that is typically a good time to buy bonds. It is probably further exacerbated by a frozen Fed. Now, that's a little counterintuitive because you're like, typically, if the Fed is easing, that's good for bonds. But the reality is, if the Fed isn't delivering monetary policy, if monetary policy is tight relative to aggregate slowing, that's actually a good scenario for bonds, meaning because you're going to have weaker economic conditions relative to what's priced into risky assets, and that should create a bid for long end bonds. And so I think that's the sort of fundamental divergence that we're seeing in the bond market, in the treasury market. One of the interesting things, if you go then to credit, and I often think about this thing, kind of separating the two, which is between the treasury component and the credit spread component. Actually, credit spreads, of all the different growth assets that are in the US economy, credit spreads are actually one of the cheapest buys of growth. Meaning, if you look at high yield credit spreads, yeah, they've compressed and they're kind of low relative to history, but the credit quality of those credits has improved a ton. And if you factor in things like, volatility and fundamental cash flow measures, you kind of see like credit spreads are kind of high yield credit spreads are kind of neutral relative to history, whereas equities are radically elevated in comparison to history.
That's an interesting perspective, because it would argue that if you're going to be bullish on equities, but you want to be relatively, in quote, safer, which we know is a loaded term in our business, that high yield is probably the better place. But it does beg the question of, sure, they might be neutral, but are they also vulnerable, right?
Yeah. And I think the challenge with holding equities at this point is you have to have very high growth in order to meet those expectations, very high earnings growth. And so even like fine earnings growth would be below those expectations and would likely be detrimental to stocks. Whereas when you think about a credit risk, it's the downside component of credit risk is really around an acute recessionary environment. And what we're talking about here is not an acute recessionary environment. What we're talking about here is growth that is slower than very elevated expectations, right? I know it can sound subtly different, but it is actually meaningfully different in terms of how those two assets play out. And so you're right. Like they will trade the same in a left tail negative growth environment, but they will trade pretty differently in merely a slower than expectations environment. And I think that's kind of where we're at ahead.
I'm sure you've seen a lot of the same data as a lot of people here that look at 10-year forward return expectations when your starting valuation is where it is for the US markets. And it's not exactly encouraging for the long-term equity investor. But the reality is a lot of people don't think in those terms. They think very short term. And the reality is, things are still going up and there's still a lot of optimism around Trump, tariffs be damned, all this. At what point do you think these elevated valuations matter?
Well, I think they matter they matter one of two cases. One in which the hard macroeconomic data is so overwhelmingly obvious that you're having a disconnect between what's in the market and what's priced into the market and what's actually happening in reality. Or two, it's reflected in earnings. Now, those things are related to each other, but ultimately, the weaker real economy conditions are likely to be reflected in weaker earnings growth. If you're a macro person, you kind of see those two things connected, meaning like if you see that retail sales is flat over the course of the year, your real retail sales is flat or real PCE is flat over the course of the year, you're probably not going to get a lot of earnings growth in retailers in the U.S. economy. That connection is relatively straightforward, but it may take actually getting weaker than expected earnings growth to play out before that recognition happens. And I think part of this is really, it's about timeframes. Like, I run into this conflict as a person who was running portfolios from a macro perspective at, $100 billion hedge fund. We couldn't think about, trying to pick off, 5% moves in the stock market. To be frank, 5% moves in the stock market didn't matter to us. What mattered is we had to position ourselves over the course of a period of time, over the course of weeks or months, in terms of how the economy was going to play out over the subsequent 3, 6, 9, 12 months because of the way in which we had to position. And so that's really where I'm always thinking is, okay, where are we likely to be 6 months forward relative to what's priced in? Like what's happening, stocks go up 5%. I don't know. Stocks go up 5%. They go down 5%. Who cares? If you're playing the game where you're trying to pick off 5% stock moves, like you're going to spin yourself up in circles because there's not a lot of signal in those sorts of shifts.
Reminder, folks, for those that are here for the C credits for the CFP board, I will email everybody here. Just make sure you stay to the end of the discussion here and you'll get an email so I can get that information from you. Also, if any of you want to ask questions, don't hesitate to put it in the Q&A box as well as in the chat. We'd love to make this as interactive as possible. You use the term position. A lot of people are not positioned for international markets to run. And I want to get your thoughts on how the economic state looks for anything outside of the U.S. I know that's very broad because we're talking about Asia, Europe, obviously Latin America, but let's talk about international economics and then international equities and then positioning within that.
Yeah. I mean, I think, it's interesting if there wasn't this tariff story and this immigration story in the U.S., what we would be talking about would be a global coordinated fiscal and monetary easing, right? And one that in some ways has pretty peculiar characteristics, which is what we're having right now is a global monetary and fiscal easing in an environment where growth is actually not that bad globally. Like, it's softer than coming right out of COVID, but like global growth is like 2.75, 3% real. Like that's pretty good. And layered on top of that, a big monetary and fiscal easing should be supportive to growth particularly outside the U.S. And so it is a bit of a weird circumstance where the U.S. is running like very negative growth policies with a frozen Fed. And at the same time, you've got all of this easing and stimulation happening elsewhere. And, that is, a dozen cuts from the ECB. That's the UK starting to ease. That's Japan continuing to run monetary policy that's easier than expected. Sorry, no yen and carry squeeze for you. That's China. I had to slide that in there. Just that's China running big very easy monetary policy and expanding their fiscal positions. Like it's kind of everywhere, and that generally is a decent growth and lots of easing is generally a pretty good time for equity markets. That's whenever you're looking at it, it's a pretty good time for equity market.
Question from Mikkel talked about prospects for a sovereign debt crisis. Now, I remember 2011, you had a lot of concerns around a sovereign debt crisis sparked by Greece. Now you've got a lot of people talking about a sovereign debt crisis sparked by the U.S. Given deficits. It's always been odd to me. It's like everyone always talks about U.S. government debt, but nobody says at what percentage of GDP is the marginal line, right, where the things kind of really tip over. So, I mean, what do you think? Are these concerns around a sovereign debt crisis in the U.S. and maybe even overseas valid? I mean, what's your thoughts there?
I think a lot of folks are maybe not as crisp about delineating sovereign debt crises in places like Greece, Argentina, et cetera, and places like Japan and the US, et cetera. And there's an important distinction between those two cases, which is, Greece had a large external debt stock in a currency they couldn't print themselves, right? They were relying on the ECB. Ultimately, they actually resolved it because the ECB printed a bunch of money and transferred that money over to Greece and was able to absorb the debt without an explicit currency devaluation. But that's that sort of, let's call it credit, meaning borrowing in a foreign currency and then not being able to pay back, is a very common a debt crisis that we've seen through history, but it is a totally useless framework for thinking about developed world sovereign debt in currencies that you can print. And so I consistently go back to kind of the same question when people bring this up, which is, okay, tell me which country in the world has the largest, which large developed world country has the largest debt stock? The answer is Japan. We all know that. Which country has the lowest, which of those countries has the lowest benchmark interest rate? Let's say 10-year interest rate. The answer is Japan. Okay, well, so what are we talking about here? And the reason, what we're talking about here, the reason why Japan can have both the highest debt and the lowest yield is very simple, which is that the BOJ has bought as many bonds as necessary to ensure that the interest rate is appropriate given the economic conditions. And there's no reason to believe that the US wouldn't do the same thing. Now, that doesn't mean that yields can go up, they can go down. It's not that big a deal. But ultimately, the Fed has a put on the bond market. What that means, though, that put on the bond market is that weakness, that need for a weak real return on bonds because of the over-indebtedness, it has to come out somewhere. And the way it works out, the way it comes out is that giving on the currency, and particularly giving on the currency relative to other things, relative to hard assets that people aren't necessarily benchmarking against. So whether it's gold, we could argue about Bitcoin, but certainly gold is a very clear one. What we're seeing globally is gold is going up against all highly indebted developed economies that are facing this sort of circumstance. And so much more likely that we see bonds, let's say bonds relative to cash, returning fine, mostly in line with economic conditions, at a time when these currencies are being devalued relative to hard assets, whether it's gold or other, physical assets as well.
Talk about tariffs. Everyone's favorite topic, tariffs, which again seems to be oddly bullish for international markets, at least when you look at those stocks. Where are we on tariffs? I mean, I can't keep up, man, when I'm with these heads. I have no idea. And I'm like a chick with that head most of the time when I'm working. And then I see, tariff, Trump's doing a tariff here. He's like, Oprah, you got a car, you got a tariff. What's going on?
The way I describe this is we are moved from a no tariff environment, by and large, to a high tariff environment. The magnitudes of which are uncertain, but the direction of which is pretty clear. And that we are just getting started in terms of feeling the effects of that. The reason why that is that there's some mechanical reasons why it takes a reasonable amount of time from when a tariff policy gets announced to actually when the tariff is collected, because the tariffs they take some time from announcement to effect. They take some time because they only affect newly loaded products onto boats. The boats have to get over to the US. And then there's a delay in the actual payment of the tariffs up to 45 to 50 days because of the way that the CPB does the actual payments, which I know is getting into the weeds. But long story short, what you see is like, you could announce a tariff today and it can take something like 3 to 4 months to actually get collected. And then on top of it, it can take 3 to 6 months to actually get that product on shelves. So this is a very long, slow play thing. So people are like squinting at, CPI data in April and are like, there's no tariff impact. It's like, yeah, of course there's no tariff impact. It takes a long time. And so what I'd say is we're moving in that direction. That direction, a tariff is a tax. It's that simple. We see no indication that foreign producers are paying the tax by reducing their prices. All indications are they're maintaining their prices. That means the tax is going to either be paid for by U.S. businesses or U.S. households. And just like any other tax, it's a negative growth impulse on the economy that's likely to be in the ballpark of 1.5% to 2% of GDP. And as a result, that's a pretty big tax hike that exists on the economy. Like, it's multiples of the relatively marginal tax cuts that exist in Build Back Better, or the big beautiful bill, I should say. It's many multiples of what's there, and that stuff is out more in 2026 than in 2025. So it's a negative growth policy. It's a negative shock. It's a rise in taxes. It's going to be with us for an extended period of time. Could it reverse? Yeah, of course, anything could reverse, but it seems like, if you look at even the consensus, like smart investors consensus, like basically everyone's accepting we're going to be in a mid-teens to as high as 20% tariff environment for the foreseeable future. That's kind of the consensus expectation.
I'd argue that because people's attention spans are so short now, the alpha really comes from that lag, right? And that patience and positioning in advance. So in many ways, you can make the argument that markets are far less efficient long-term than they used to be because there's no respect for the lag.
Right. I mean, if you talk about, hey, look, there's going to be a tariff effect, that's going to cut down household consumption by 2%, 3 to 6 months from now. People are like, yeah, but stocks were up 12 basis points yesterday and you're a moron. And it's like, okay, well, there's not much you can say about that.
This is why I only put my replies to those I follow on X now. That's that and the bots, right? It's but I love that slip you did. You said Build Back Better, but actually big beautiful bill. And then thinking to myself, the commonality is triple B, and then maybe where our credit rating is going for the U.S. So let's talk about the big beautiful bill a little bit here, because it's pretty big. I don't know if people really are aware of like the magnitude of the pork and all the stuff that's gone in, but which is, you can argue, typical. And also why Elon Musk is now trying to form another party and all this. But what do you think the implications are on the big beautiful bill? What are some things that you think are not getting as much attention there?
Well, I think, first of all, I think the political rhetoric is like confusing to people because it's described as the biggest tax cut that the U.S. has ever seen. And from a macroeconomist perspective, it's like the biggest, the biggest not tax hike that the U.S. has ever seen. Meaning, like, it's basically just a continuation of current policy. That's it. Just big picture. It's not that much different from that. It's kind of like existing tax policy will exist in the future. There are some, frankly, nuances beyond that from a macro perspective that some of which are beneficial, meaning like there's some incremental reduction in taxes on tips and Social Security and some, expensing, accelerated expensing for investment in plant and equipment, which are marginally, we're talking like pretty modestly, like 0.1% of GDP beneficial to growth. And then on the flip side, there are cuts to social services, particularly in cohorts that are, high propensity to spend groups, like things like, the Medicaid cuts and things like that, which are a few tenths negative. And the dollar value of the benefits are likely bigger than the dollar value of the cuts, but the cuts are for people who would be more likely to spend the services. And so the net effect is like kind of zero, which I know is kind of boring, right? It's like there's all this stuff, and the gist is it basically has no effect on the economy when you net it all out. And that, that's what it is. That's from a macroeconomic perspective. You just added all the effects up, and it's kind of like a zero. And so I highlight that because at the same time, you have essentially one of the greatest, fastest tax hikes that the U.S. has ever seen with the tariffs. And you have one of the greatest constrictions of labor supply and immigration that the U.S. has ever seen. And so those are two very big negative growth policies at a time when kind of everyone's focused on the big, beautiful bill, which is kind of a zero when it comes to the macroeconomic implication.
We'll talk about your funds in the next 10 minutes, but I want to get through some of these. From an anonymous attendee, do you believe we can see an elevated inflationary environment for the foreseeable future due to tariffs and/or an increase in M2? Also, any commentary around Treasury buybacks and issuance schedule? Here we go with Yellen 2.0 under right? Continue to roll bills to fund deficit. So look, let's take a step back. This has been a concern a lot of people have noted for the last year and a half, that now is around the time when you've got a big rollover and you can roll over into much higher interest expense, right? And there are concerns that that's going to choke the economy, although maybe not, right? Because who knows? But yeah, let's riff on that for a little bit.
the debt profile of U.S. issuance is an important component of aggregate financial asset supply and demand. If you just think about it, like selling bonds is just like selling assets, and somebody's got to buy them. It's that simple. And there's a big difference in the financial markets between issuing a bill, which is essentially like cash, and the riskiness that's perceived there. It's like essentially cash adjacent, versus issuing, a 30-year bond, which has got a lot of volatility, and you essentially have to accept greater risk. The question really is whether or not we see a shift of that debt profile in terms of the duration, the typical duration or average duration of the issuance of the U.S. If they shorten it, that's actually good for financial assets because it means that there's less, risky asset supply. If they lengthen it, it's bad for financial assets. There has been, I'd say, there's some questions about what's going to happen. The president, in a unscripted meeting, press conference, around the desk, said we're going to stop issuing any debt over 9 months. Now, that did not actually translate into the Treasury auction schedule, the subsequent Treasury auction schedule. So it's not really clear whether that's a flippant remark made, in anger, or whether it was, a flippant remark made with no consideration, or whether it was actually administrative policy. One of the ways in which we'll see how that plays out is in the QRA announcement, which happens at the end of July, which is where the Treasury basically officially outlines what its mix is going to be ahead, its issuance mix is going to be ahead. The reality is, like, so few people look at the QRA or even understand what its implications are. You don't have to bet ahead of time to figure out what's going to happen. Like, wait to see what happens in the QRA. It will take time to flow through the markets. You can respond in position once you see what the policy actually is, and you'll be in good shape. And it'll be interesting to see. Are they going to cut duration issuance, or are they going to keep it the same? Probably not going to extend it. Besson has already made that clear. They're not going to extend it. But if they keep issuance supply basically the same, then, this is a nothing thing. If they cut it significantly, then that's good for financial assets. It's good for stocks. It's good for gold, and it's likely bad for bonds.
All I heard there was so few understand the QRA. Few understand was the thing that really got my attention.
Yeah.
So the another question here from Alex, which you kind of alluded to a little bit. Some analysts have suggested that we're going to see a deflationary market event later this year, caused by a Fed policy error, rates too high for too long, and deportation. Your thoughts? I will throw in there, and maybe a reverse carry trade. I know we go back and forth on this. Although it is interesting, I will say something about this. And maybe this is kind of another sort of interesting side question, which is, do deflationary pressures have to be an event at this point? Because there's just constantly reactions that prevent a prolonged deflationary cycle.
Yeah, I mean, I think I'd probably describe it. I think people can mix deflationary environment with weak growth environment. And what I'd say is, I think we are shaping up for a weak growth environment. Whether that's deflationary, I mean, in general, weaker growth conditions are disinflationary, right? They generally bring prices down. It's complicated. Honestly, it's complicated to know how this is all going to net out, because we have the tariffs, and that's inflationary, and you have, weaker growth environments, and that's on the margin disinflationary. And so what I'd say is kind of like the range of inflation at some level is not that interesting, because it might be. And it's also kind of depends on how it gets measured and all that stuff. Like, are we at 3.3 or 2.5? Like, who cares? It doesn't really matter. The real question is, are we going to be in a negative growth environment? In response to what you're saying, like, odds are a negative growth environment will not persist for an extremely long period of time, because frankly, policymakers have learned that there are tools that they can use to be responsive to that. But it's important to recognize that the way this works is, first, you have a negative growth environment that affects asset prices, and then you have the reflation, right? And I think a lot of people are like, well, the Fed will have yield curve control in a negative inflation, a negative growth environment, therefore buy stocks. It's like, that's not how it works. First, stocks go down, and then they respond. That's how it works.
The mechanism also there is around credit spreads blowing out, which is why they never stepped in the midst of that tariff tantrum, right? I mean,
right.
Which is right. Hard. I mean, I remember on that Saturday or Sunday, I was watching Bloomberg, and futures were down 1,500 points. It was a Sunday. And on Bloomberg, they had Nouriel Roubini, and he said, what I myself have argued, I think you as well, it's like, why would the Fed step in? Spreads were barely budging in the midst of the panic. So It all goes back to that. Another question from Nick here. Going back to markets, views on the impact on global liquidity. Global liquidity rising, supportive, dominating other macroeconomic data for assets. So I'm sure you know Michael Howell. His global liquidity framework is a very popular one.
Yeah,
and it does seem like everything's driven by liquidity, and fundamentals be damned as well. What are your thoughts there?
Well, I think what I'm describing about the coordinated monetary and fiscal easing, I think is consistent with and the primary driver of the high liquidity environment that's going on right now. I think the question is who gets the benefit from that liquidity? And the reality is, the U.S. has gotten the benefit of that liquidity for a long time, for like 15 years. And as a result, you've seen asset markets rise a ton. But that has required a lot of foreign investors to basically be extremely overweight U.S. assets along the way. And instead, I think what we're starting to see is those investors are starting to pull back on their extreme overweights of U.S. assets. It's a sort of process that takes a long time to play out because you got to change. If you think U.S. policymakers are slow, imagine like being in a European, pension fund allocator. We're talking about it takes years for this stuff to play out. Just in the same way it took years for them to build up the position, it'll take years for them to move in the other direction. And so probably what we're going to see from the U.S. perspective is that drag from the withdrawal of overweight U.S. positions is likely to offset the global liquidity benefits, plus the tight, the negative growth policies in the U.S. Those are likely to offset what would be sort of the leakage of global liquidity in. And it's one of the reasons why holding foreign stocks relative to U.S. stocks, if you're going to hold equity risk, it seems much more compelling to hold foreign equity risk than it does holding U.S. equity risk right now.
It's a good transition to talk about your products, your funds, things that are coming in the pipeline. Focuses obviously on the hedge fund replication side of things. So let's get into it. How are hedge funds positioned?
One of the interesting things is if you think about these themes, they actually line up pretty well with how particularly global macro managers are positioned. And in our HFGM product, we basically use technology to understand how all these macro managers are positioned, and then put that into the ETF wrapper and do it at a 2x target return. So as a higher target return or more cash efficient. And it's interesting to see how the positioning of those managers is actually quite aligned with some of the themes that we talked about. So as a simple example, global macro managers have been picking up their long bond positions. Now, that's a bit of a shock, right? Because you hear everyone in the world is issuing bonds and saying they're a terrible bet, but in a weaker growth environment, they're actually a pretty good bet, right? So they're increasing their bond positioning as yields have risen, increasing their gold positioning. In sort of risky assets, they're notably long. They're positioned away from U.S. equities and towards things like U.S. high yield credit and global equities. And they're moderately short the U.S. dollar, which has been a pretty good trade as well. So that's kind of, in many ways, a lot of the themes that we just talked about are sort of aligned with how they're positioned more broadly.
How often do these positions change? And let's talk about the process behind HFGM.
In general, hedge funds, if you're managing any meaningful amount of capital, like you can't instantaneously trade your positions. Like you can't go short stocks one day and long stocks the other. You just can't do it because you get eaten alive by transactions costs. And so, like I talked about a little bit earlier, like most meaningfully sized funds, they're thinking months ahead of what's likely to happen and positioning for months ahead, because it can take weeks or even months to shift your positions and not, take on the transactions costs. And so what we see is, typically managers are shifting over, months in terms of their position, which is, pretty good in the context of longer cyclical conditions. We've seen a bit faster shifting. I mean, what we do with our technology is we look every day in terms of what the positioning is, and we can infer that. And so we've seen them sort of increase the pace of issuance because there's always, of shifts, because there is always a trade-off between essentially alpha decay, meaning like if it takes a long time for you to get in the position, you're expected value starts to go down, and transactions costs, those are the trade-offs. So they've been a bit faster, like shifting over, weeks or a small number of months. But in general, it's not the sort of thing that flips on a day-to-day basis.
I'll say congrats on live here. That ETF came out, looks like early May.
From April 15th.
April 15th, okay. And you've got 20 million, which, by the way, is very good. By the way, for those that don't know how hard the ETF landscape is. As somebody who's been in the business since 2012 running funds, it is brutal, the business of raising assets, especially when you're a newer fund. So that clearly resonating. Performance has been strong. Nice timing, obviously. Also post-tariff, you can argue.
Yes, yeah. It's been a good environment for macro managers in the last 3 months. The thing I think is neat about it is, often people will be like, oh, well, stocks are up too. But that return has come with an 0.2 beta. So what it means is it's not like they're actually the vast majority of that return. It has nothing to do with equity risk and has a lot to do with positioning well in bonds and credit and currency positions and commodities and gold. That's where the vast majority of the returns have been derived. And so it is, even in going up, in a period where stocks are going up, it's actually it's been a diversifying strategy as well.
So there's no way to actually see it on that fund in particular, but during that tariff tantrum, how did macro managers in general position, or did they do anything at all?
When you get sort of a shock, right? You essentially had a policy shock. You can't necessarily position instantaneously in one direction or another. No hedge funds are of meaningful size are taking advantage of 7-day movements in prices. It's not happening. And so what we did see for those managers is, given the uncertainties of how that policy would play out, they actually cut their leverage a lot going into that moment, right? Because it was an uncertain environment. And, part of the skill of managing money effectively that you see in hedge funds is not just making the calls, up or down, right? But it's also knowing when you have the confidence to make a call and when you don't have the confidence to make a call. And so they're able to cut risk going into that and then start to scale up their risk taking once the direction of travel was a little bit clearer later in the month.
Today's a special day. And it's not because I'm talking to you. It's special for me. It's not really special for you because, who am I? All right, Michael Elliott. But we should talk some news.
Oh, yeah. Well,
that thing. Yeah.
Yeah. We've been around for 3 years, and we've had our first product, HFND, which has been around for a while, for almost 3 years, which is really, I kind of like to say, it's kind of like the SPY for hedge funds. It's just basically matching the index returns. It's done a good job demonstrating that we can track how hedge funds are positioned, but we've been really focused in this year on breaking out those individual strategies and offering them to investors at a higher target return. So they're a lot more cash efficient. And so we started with global macro, which we talked about, but today, as you mentioned, is an exciting day because what we've also done is launched 2 additional strategies, 2x target, managed futures strategy. So a much more cash efficient way to get exposure to the managed futures return profile. And secondly, launched a 2x target return equity long short strategy, and really addressing one of the key problems with equity long short strategies in a portfolio, which is they often are targeting lower returns, bond-like returns, to something that has much more, that's targeting equity-like risk and better than equity index-like returns with lower volatility in that ETF wrapper. And so I think quite a compelling story, whether you're looking for sort of a diversifying defensive risk, the way managed futures comes, a much more cash efficient way to do it, or if you're looking for alternatives to simple equity and index investing run by hedge funds, the most sophisticated investors in the world, their views on markets as well. So that's the portfolio these days.
So HFMF and HFEQ, for those that missed it, definitely put those on your watch list. Now that you've got 4 funds, the big question is, which one's your favorite?
Ah, well, I like all these strategies. I have to say, you're not supposed to pick which child you love the most, but every parent does love one child more than the others. And I have to say, I love the macro strategy because I'm a macro guy by trade, and I think it's a really nice sort of all weather alpha that can fold into a lot of portfolios and have benefit. But I'm excited, honestly, for these new strategies, because I think equity long short hasn't quite gotten its due because the target returns have been so weak, so low, and so I think it's quite interesting. And managed futures, it's a great strategy. There's not that many defensive, positive expected value strategies out there in the world, and I think a lot of folks struggle with the lack of cash efficiency, like running a bond, like risk, and how much capital you have to allocate in order to get the beneficial, in order to get enough benefit in challenging times. And I think with this 2x target return strategy, we've got an ability to bring a defensive strategy to the table that can kind of fly under the radar until it's doing what it needs to do.
I'm a big believer in alternatives, but importantly, alternatives that are alternatives to the alternatives. So I know it's obviously early, but when you think about the 4 products, would you expect them to be largely correlated over time, low correlated against each other? Because if it's the latter, then there's an argument to own all of them.
Yeah, I mean, it's actually, we've done some work thinking about sort of what is the sort of optimal mix. And the reality is holding roughly a third is pretty close to the optimal mix. And I think when you do that, it has considerably less equity beta than sort of like traditional hedge fund strategies, which basically, to be blunt, have too much equity in them, too much equity beta in them. And so by pulling each one of the pieces out and putting them together, being able to put them together and weigh them individually, what you can do is have a much more consistent return, sort of get the alpha opportunity from the equity managers, from the global macro managers, from the managed futures folks, and sort of pair those all together in a really compelling way. And so I know it sounds in some way overly simple to just say, you can get a third is a pretty good way to allocate across them, but that's how it works.
Again, folks, for those that are here for the CE credits, I will email you for to submit the information to the CFP board. I will try and see if I can get this up as a podcast, but always good to sign up to these discussions, as we're going to be doing these more on a monthly basis, covering a whole bunch of different topics. Anything that we missed, Bob, that you think is worth kind of mentioning here in the final few minutes?
If folks are, the only thing I'd mention is if folks are interested in exploring whether these hedge fund strategies are good for their portfolio, definitely feel free to reach out. We've got a network of dozens of independent financial advisors who have found these strategies to be quite compelling in terms of their strategic portfolios, and would love to add more to that network. So you know where to find me. We're here. Or you can just ask Michael and he'll put me in touch with you.
Unlimitedfunds.com. And Bob's getting to the point where people know of Bob Elliott's name, but they don't know from where. And that's always, to me, been the sign of success. If people can't pinpoint where they know you from, you've made it. Appreciate those that attended this. Again, we'll be doing more of these. Make sure you follow Bob on X as well. And you launched a Substack. I
did. I recently launched a Substack under Non-Consensus is the name. You can find it if you Google Bob Elliott, Non-Consensus, or Substack, or some combination of those. You can find it, which really is a deeper dive into sort of my day-to-day macro thinking questions, just kind of looking over the shoulder of what I'm thinking about every morning at 5 a.m. when I wake up. You can definitely check that out and subscribe and get some of that insight.
So that way, if you also in the audience are waking up at 5 a.m. and you happen to be thinking about Bob Elliott at 5 a.m., you know where to go. It's not just him. You can think of him. Anyway, thanks everybody for joining. We'll see you all on the next webinar. Thank you, Bob. Appreciate it.
Thank you.
Cheers, everybody.